What did these stress tests tell us about the state of the banking industry?
Well, they told us that that in a severe stress scenario, was as the Fed has defined it, they would survive quite well and still have plenty of capital to keep lending. But I think there were a lot of problems with the scenario and the assumptions that underpin the stress test. So I don't think we should take a lot of comfort from it. There's a lot of work that needs to be done. And to its credit, the Fed acknowledged that there are a lot of different potential risks out there that may not be reflected. So I do think we should not take a lot of a lot of comfort in this. The big issue, obviously, is they don't stress high interest rates. That is the issue confronting the banking industry right now. And ironically, if you assume, as their stress test does, that rates go back to zero in a severe recession, that actually helps banks that have a lot of unrealized losses on their books, because when you take rates back to zero, those low yielding assets regain value quickly. So in a way, they're rewarding banks for not managing their interest rate risk very well, and that's a big problem. The other issue is that, again, related to interest rates, is what happens if we have a protracted period where the yield curve is inverted, meaning that short-term borrowing rates are higher than long-term rates, which is a situation we've had for a while now. That leads you into a situation which we're already seeing, where banks' cost of funding, what they have to pay on deposits or borrowing, will exceed what they can get on their loans. And that's going to be a real challenge for banks. And those are the kinds of issues the Fed really needs to be thinking about and putting banks through. Not this kind of artificial assumption that if we have a recession, rates go back to zero and we start the party all over again and their assets are inflated and they don't have to pay anything on the deposits anymore. That's just not realistic.
How does liquidity figure in? Because one of the issues, obviously, in a lot of these banks that failed is they just didn't have the liquidity, so they had to sell the securities, as you pointed out. Does liquidity factor into the stress test? Should it?
It does not really. There are separate tests on liquidity. They're not public, but they probably should be public, and that liquidity risk needs to be integrated into the capital stress testing, because you cannot separate these out. A bank that is perceived to be weak by the market will likely have deposit runs or accelerated deposit withdrawals. That means that they might have to sell securities they weren't planning on selling, the so-called hold-to-maturity securities, which will have a big impact on capital. So these need to be integrated together. You can't just have a clean separation. And again, that's part of the broader interest rate scenarios, liquidity risk, as they impact capital, that the Fed should be running these banks through.
We're talking about the banking sector, the regulated banking sector right now. There's a lot of transactions being done outside of that, as you know so well. And if anything, that has been growing dramatically. Ironically, perhaps in part because of the difficulties the banks are having. So they're getting out of some of the business that private credit is stepping into. Is there an effective way to take into account the possible systemic risk from the non-bank banks?
So it's a huge issue, because in my experience, we had a lot of non-bank lending during the great financial crisis. They were doing the lion's share of the mortgage lending, right? The big banks were doing the securitizations that fed the beast, but they were doing the lion's share, and they still do, frankly. But those sources of credit dry up very quickly if you get into distressed market situations. The banks that have stable deposits are the ones that keep lending. So if you keep squeezing the banks, and if we overreact, especially with the smaller banks, the regional community banks, to recent failures, you're going to even push even more of that into the private sector. You're going to constrain their ability, the non-bank sector, you're going to constrain their ability to lend, and that's going to make the system even more fragile. There's also not a lot of transparency between the intersection of the regulated banks and the non-bank sector. Again, this was a huge problem during the great financial crisis. Most of the mortgage lending was at the non-banks, but it certainly flowed back into the banks when troubles emerged. So this is another huge area that supervisors have not been sufficiently focused on. We've been talking about non-bank risk for years. There are tools that were provided in Dodd-Frank to deal with it. They're not being used very well. And, just more scrutiny. This is more an issue for the larger banks and the interrelationships that they have with a lot of these private equity funds, venture capital funds, other, so-called private funds. Those losses, to the extent those bank customers are going to have problems, that's probably going to flow back into the larger banks as well. we don't have a good understanding of that risk.
You referred to regional banks and also community banks and their role overall in the ecosystem. That's certainly come to the forefront. How concerned should we be about the role of the community banks, the regional banks, versus the big money center banks? And is there something we could do to really ensure their strength? Because they do provide a lot of the lending and the credit to some of the smaller businesses across the country.
They do. And those are the engines of job growth. So yes, I've been saying for some time now, we need to at least have a temporary guarantee for transaction deposit accounts that these smaller banks have with their business customers and other institutions like, local governments, nonprofits. These are accounts that are used by their customers to pay bills, to make payroll, to bring revenues in, pay expenses. They're operational. They don't move easily. But they're almost always above the insured deposit limits because you got a lot of money flowing in and out to pay expenses, payroll and other bills. So we provided a temporary guarantee for them during the great financial crisis. We were seeing deposit instability then with the smaller banks. Those deposits were migrating to the so-called too big to fail banks. You want to stop that. We've had enough consolidation already. So reinstituting, at least on a temporary basis, this guarantee again, I think would be hugely stabilizing to those regional and community banks. Unfortunately, in Dodd-Frank, for whatever reason, it took the authority away from the FDIC using what's called a systemic risk exception which is an extraordinary procedure, to reinstate that. Now there's a fast track approval process in the Hill. It needs to be required. The president has to ask for it. The president, for whatever reason, has not asked for it. But I do think there's insufficient focus on stabilizing liquidity for these community and regional banks. The more they have to, pay really high rates on deposits or borrow from the Federal Home Loan Bank, which is really expensive borrowing, the more that is going to distress them and constrain their ability to lend. We need to stabilize those accounts, especially transaction accounts, with a much higher, if not unlimited guarantee, at least on a temporary basis.